In our last series, we looked into the abyss of BlackRock. We saw a $10 trillion monster that influences housing, media, and governments. We saw Larry Fink as the face of modern financial power. But every time you look at the top shareholders of a major company, you see a pattern. You see BlackRock. But right next to them, often even ahead of them, is another name. A name that sounds ancient, almost military. Vanguard. So, a natural question arises. If BlackRock owns Apple, and BlackRock owns Microsoft, and BlackRock owns Pfizer, who owns BlackRock? If you pull up the financial filings, the answer is staring you right in the face. The largest institutional shareholder of BlackRock is the Vanguard Group. It feels like a glitch in the Matrix. It feels like a Russian nesting doll of power. You open the BlackRock doll, and inside, there is a Vanguard doll. But if you try to open the Vanguard doll, you find something very strange. You find nothing. Or rather, you find everything. Vanguard is the ultimate ghost in the machine. It manages over $8 trillion. That is 8 trillion. It is the second largest asset manager on Earth, breathing down BlackRock's neck. But unlike BlackRock, which is a public company that you can buy stock in, Vanguard is a mystery. You cannot buy shares of Vanguard on the stock market. Larry Fink goes on TV every day. The CEO of Vanguard, most people don't even know his name. They are the silent giant. They don't write letters to CEOs about climate change. They don't try to be famous. They just quietly, methodically absorb the world's wealth. In this series, we are going to investigate the company that owns the company that owns the world. We are going to look at the man who founded it, a man who hated Wall Street and was hated back. We will explain the mutual structure that makes Vanguard unique and dangerous in its own way. And we will ask the question, is Vanguard the benevolent grandfather of investing? Or is it the final, invisible layer of the monopoly? Welcome to the story of the Vanguard Group. To understand BlackRock, we looked at Larry Fink, the ambitious bond trader. To understand Vanguard, we have to look at a man who was the complete opposite. John Clifton Bogle, known to his friends and his millions of fans simply as Jack. Jack Bogle is a legend, but he wasn't a billionaire. When he died in 2019, his net worth was estimated to be around $80 million. Now, 80 million is a lot of money to us. But for a man who managed trillions, it's pocket change. Larry Fink is a billionaire. Stephen Schwartzman of Blackstone is a billionaire. Why wasn't Jack Bogle? Because Jack Bogle spent his entire life fighting against Wall Street greed? He was the saint in the den of thieves. His story begins in the 1940s. He wrote a senior thesis at Princeton University that laid out a radical idea. He looked at the mutual fund industry, where managers were paid huge fees to pick stocks, and he said, "These guys are useless." He argued that most active managers couldn't beat the market average, especially after you accounted for their high fees and taxes. He believed that the financial industry was essentially a giant vampire squid, sucking value out of the pockets of the little guy. He famously said, "In investing, you get what you don't pay for. The lower the fees, the more money you keep." For years, nobody listened. He worked his way up in the traditional finance world at a company called Wellington. But he was a maverick. He was stubborn. He was arrogant. And in 1974, he got fired. It was the best thing that ever happened to investors. Humiliated but determined, Bogle decided to start his own company. He named it after the HMS Vanguard, Lord Nelson's flagship at the Battle of the Nile. He wanted a name that signified leadership and battle, because he was going to war. He was going to war against high fees. He was going to war against the idea that you need a smart guy in a suit to manage your money. In 1976, Jack Bogle launched the first index investment trust. Today, we know it as the Vanguard 500 Index Fund. The idea was laughably simple. Instead of hiring expensive analysts to research and pick the best stocks, Bogle simply bought every single stock in the S&P 500. Wall Street laughed at him. They called it Bogle's folly. They said it was un-American to settle for average returns. They printed posters saying, "Help stamp out index funds." Why did they hate it? Because index funds don't require expensive managers. They don't generate huge commissions. If indexing worked, Wall Street's profit margins would be destroyed. The fund launched with a whimper. It raised only $11 million. The underwriters were embarrassed. They wanted to cancel the whole thing. But Bogle refused. He said, "If we can't sell it, we'll just wait." And he was right. The math was on his side. Over time, the average return of the index fund, minus the tiny fees Bogle charged, started to beat the superior returns of the active managers. Year after year, the Vanguard Fund crept up the rankings. It wasn't flashy. It didn't have explosive years. It was the tortoise beating the hare. By the 1990s, the floodgates opened. People realized the game was rigged against them. The folly became the standard. Today, passive investing accounts for over half of the US stock market. And it all started with Jack Bogle being too stubborn to quit. But the real revolution wasn't just the index fund. It was the structure of the company itself. This is the key to understanding why Vanguard is different from BlackRock. BlackRock is a publicly traded company. Its ticker symbol is BLK. It has shareholders, and like any public company, it has a legal duty to maximize profits for those shareholders. This means BlackRock wants to charge you, the investor, as much as possible without losing your business. There is a conflict of interest. They serve two masters: the clients who give them money to invest, and the shareholders who own BlackRock stock. Vanguard is different. Vanguard is a mutual company. This is rare in the financial world. Here is how it works. Vanguard is owned by its own funds, and the funds are owned by the investors. This means if you buy a Vanguard ETF or mutual fund, you technically become a part owner of Vanguard itself. There are no outside shareholders. There is no Larry Fink collecting a $1 billion bonus. There is no stock price to worry about, because there are no outside owners to pay. Vanguard doesn't need to make a profit. It operates at cost. Any extra money it makes is returned to the investors in the form of lower fees. This created a flywheel effect. Lower fees attracted more investors. More investors meant more scale. More scale meant Vanguard could lower fees even further. It drove the cost of investing down from 2% to 0.03%. Jack Bogle estimated that by lowering fees, Vanguard put hundreds of billions of dollars back into the pockets of ordinary Americans. He is arguably the greatest philanthropist in history, not because he gave money away, but because he prevented Wall Street from stealing it in the first place. This structure makes Vanguard incredibly powerful, but also incredibly boring. They don't need to chase trends. They just need to exist. So far, Vanguard sounds like a hero. A company built by a saint, owned by the people, fighting for the little guy. But remember the theme of our channel: there is always a dark truth. Jack Bogle created a machine to help the little guy. But that machine has grown so big that it has become the market itself. When you own a piece of everything, you control everything. Vanguard, alongside BlackRock and State Street, has created the common ownership problem we discussed in the last series. Even Jack Bogle himself, before he died, started to worry. He wrote about the index fund bubble. He warned that if index funds grew too large, if 3 companies controlled the majority of the voting rights, it would be bad for national interest. He famously asked, what happens if everybody indexes? If nobody is looking at the value of companies, does the market become a zombie? And there is another issue. Vanguard is passive in investment style, but are they passive in voting? They hold the voting power for 30 million investors. Most of those investors don't even know they have a vote. Vanguard votes for them. This creates a concentration of political power that is just as scary, if not scarier, than BlackRock. Because at least with BlackRock, we have a face. We have Larry Fink. We can yell at him. With Vanguard, who do you yell at? It's a faceless bureaucracy. It's a mutual collective. It is the Borg. In the next part, we will dive into the Vanguard versus BlackRock war. Are they really competitors? Or are they two heads of the same hydra? In the world of finance, there are 2 suns around which everything else orbits. One is BlackRock. The other is Vanguard. Together, they manage nearly $20 trillion. To put that in perspective, that is roughly the GDP of the entire United States. On the surface, they look like twins. They both sell ETFs, They both own massive stakes in Apple. Microsoft and Exxon, they both preach the gospel of passive investing. But if you look closer, you will see that these two giants are actually very different animals. Larry Fink of BlackRock is the loud, celebrity CEO. He is the face of stakeholder capitalism. Vanguard is the opposite. Vanguard is the silent giant. Its current CEO, Tim Buckley, is a man you probably wouldn't recognize if he stood next to you in an elevator. This difference in personality isn't just about style. It is about structure. But recently, the noise has become too loud to ignore. A rift has opened up between these two titans. And it is happening on 3 major battlefields: ESG, crypto, and China. Larry Fink bet the farm on ESG. He told the world that climate risk is investment risk. But then, the political backlash hit. Red states like Texas and Florida started attacking BlackRock. Vanguard did something shocking. In late 2022, Vanguard abruptly pulled out of the Net Zero Alliance. They essentially said, "We are done with the politics. We are here to maximize returns for our investors." The second major divide is cryptocurrency. As we saw, BlackRock made a massive pivot. Larry Fink went from calling Bitcoin money laundering to launching the iShares Bitcoin Trust. Vanguard, however, stood firm. They declared war on it. When the Bitcoin ETFs launched, if you had a Vanguard account, you were blocked. "Who is Vanguard to tell me what I can do with my own money?" they asked. But Vanguard didn't blink. This comes straight from the ghost of Jack Bogle. He famously said, "Avoid Bitcoin like the plague." He believed that an asset must generate cash flow to have value. So, we have a clear split. BlackRock is betting that crypto is the future. Vanguard is betting that crypto is a tulip mania bubble. One of them is wrong. The third split is geopolitical. China. BlackRock stayed. Larry Fink believes that engagement is better than isolation. Vanguard, however, did a U-turn. They announced they were shutting down their operations in China completely. Why? Because Vanguard's model requires massive scale and low cost. Despite these differences, we must ask the cynical question: are they really competitors? Or is this just a good cop, bad cop routine? Think about it. Between the two of them, they own the market. If you don't like BlackRock, you go to Vanguard. If you don't like Vanguard, you go to BlackRock. The money stays in the duopoly. Usually, when we talk about financial cults, we think of crypto bros screaming about going to the moon. Or day traders betting their life savings on meme stocks like GameStop. But there is another tribe in the financial world. They are quiet. They are frugal. They drive 10-year-old Toyotas. They don't check stock prices every day. They call themselves the Bogleheads. Named after Jack Bogle, this is arguably the most successful financial cult in history. But instead of worshiping a charismatic leader who promises instant riches, they worship a man who promised them average returns. The Boglehead philosophy is radical in its simplicity. It can be summarized in one sentence. Buy the whole market, keep costs low, and do nothing. It sounds easy, but in a world designed to make you trade, doing nothing is the hardest thing of all. The Bogleheads have a website, bogleheads.org. It is one of the last remaining corners of the old internet. No flash. No ads for scams. Just thousands of people discussing asset allocation. They treat Jack Bogle's books like scripture. To them, Vanguard isn't just a company. It's a vehicle for financial freedom. To understand why the Bogleheads are so fanatical, you have to understand the enemy they are fighting. The enemy is the croupier. Jack Bogle famously compared the stock market to a casino. He said that in the long run, the stock market is a zero-sum game before costs, and a loser's game after costs. Here is the math that Wall Street doesn't want you to know. If the market returns 7% a year, and you pay a financial advisor 2% a year in fees. That doesn't sound too bad, right? Wrong. Because of the tyranny of compounding, that 2% fee doesn't just take 2% of your money. Over an investing lifetime, that 2% fee will consume nearly 60% of your final potential wealth. Let that sink in. You take 100% of the risk. You put up 100% of the capital, but the croupiers take 60% of the profit. Jack Bogle saw this as a moral outrage. He called it the croupier's take. He declared war on the entire financial services industry. He said, "Stop paying the croupier. Buy the casino instead." This is why Wall Street hated him. He was taking food directly off their plates. Every dollar that went into a Vanguard index fund was a dollar that wasn't generating commissions. Bogle didn't just build a business. He destroyed the business model of active management. This philosophy has spawned a whole new generation of influencers. Authors like J.L. Collins, who wrote The Simple Path to Wealth, advocate for a portfolio that consists of just one single fund, the Vanguard Total Stock Market Index Fund, ticker symbol VTSAX. The argument is that you don't need to be smart to get rich. You just need to be patient. This is the anti-BlackRock message. BlackRock sells complexity. They sell specialized ETFs for every niche. Robotics, cybersecurity, emerging markets. BlackRock makes money on complexity. Vanguard makes money on simplicity. But there is a catch. The Boglehead philosophy works great when the market is going up. But what happens if the market stops going up? Critics argue that passive investing is a momentum trade. They automatically buy more of the stocks that are already expensive. If Apple goes up, Vanguard has to buy more Apple. This pushes Apple up further. Some analysts, like Michael Burry, have called this the passive investing bubble. They argue that price discovery is broken because nobody is actually analyzing the companies anymore. We are all just blindly buying the bucket. If this bubble pops, the Bogleheads might find that staying the course is harder than they thought. When everyone is passive, who is left to sell to when you need to get out? Vanguard's dominance isn't just because of loyal fans. It's because of inertia. When you start a new job, you are usually presented with a list of options. Most people have no idea what to choose. So, the company sets a default option for millions of Americans. That default option is a Vanguard target date fund. This means that every 2 weeks, billions of dollars automatically flow into Vanguard. It doesn't matter if the news is good or bad. The money flows. This is the power of the default. Vanguard doesn't need to sell you anything. They are hardwired into the payroll system. But it also raises the question of responsibility. If Vanguard controls the retirement savings of a nation, do they have a duty to protect that money from systemic risks? Jack Bogle would say no. He would say, don't look for the needle, buy the haystack. But the current leadership of Vanguard has to deal with a much more complex haystack. Jack Bogle died in 2019. He famously worked until the very end. But companies change when their founders die. There are rumors that the culture inside Vanguard is shifting. Some longtime Bogleheads complain that customer service has declined. Is Vanguard slowly becoming just another asset gatherer? Are they becoming BlackRock light? In the next part, we are going to look at the dark side of voting power. We have established that Vanguard is passive in how it picks stocks. They buy the index. But there is a dangerous misconception that being a passive investor means being a passive owner. Nothing could be further from the truth. When you own shares in a company, you have rights. You have the right to vote on the board of directors. You have the right to vote on CEO pay. But here is the catch. Most individual investors, people like you and me, never vote. So, who votes for us? Vanguard votes for us. Vanguard manages over $8 trillion. That translates into a massive block of voting shares. In most major American corporations, Vanguard controls between 5% and 10% of the total votes. That might not sound like a majority, but in the world of corporate governance, a 10% block is decisive. It is the swing vote. It is the kingmaker. This means that a small team of people at Vanguard headquarters essentially decides who sits on the board of Disney. They decide if the CEO of Apple gets a raise. They don't need to own 51% to control a company. They just need to own enough to tip the scales. Unlike Larry Fink, who writes loud public letters, Vanguard prefers what they call quiet diplomacy. They meet with corporate boards behind closed doors. They don't scream, they just whisper. We think you should do this. We are concerned about that, and because Vanguard represents the permanent capital base of the company, the board listens. This creates a terrifying lack of transparency. We know what BlackRock wants because Larry Fink tells us. We don't really know what Vanguard wants. Let's look at the woke capital controversy. Companies like Disney, Bud Light, and Target have made business decisions that alienated huge parts of their customer base. Why would a corporation do something that hurts its own profits? Critics point the finger at the asset managers. They argue that Vanguard and BlackRock enforce a corporate social credit score. If a company doesn't adopt certain policies, Vanguard might vote against the re-election of the board members. So, the board members, fearing for their jobs, adopt policies that please Vanguard. Vanguard denies this. They say they are neutral. But the correlation is hard to ignore. When the top shareholders prioritize social metrics, the companies prioritize social metrics. Another area where Vanguard's silence is deafening is CEO compensation. In the last 40 years, CEO pay has skyrocketed. It used to be 30 times the average worker's pay. Now it is 300 times. Who approves these massive pay packages? The shareholders. Vanguard talks a lot about low costs for investors, but time and time again, they vote to approve massive bonuses. Why? There is a theory called class solidarity. The people running Vanguard are elites. The people running the S&P 500 companies are elites. They sit on the same non-profit boards. They don't want to rock the boat. If Vanguard started aggressively voting down CEO pay, they would lose access. So, we have a system where the owners of capital are more aligned with the managers of capital than they are with the actual people whose money they are managing. You. This is the agency problem on steroids. Vanguard is supposed to be your agent, but they act like the CEO's best friend. We touched on this with BlackRock, but it applies even more to Vanguard. Common ownership. Vanguard is a universal owner. They own the entire economy. If you own the entire economy, you don't care if United Airlines beats American Airlines. You own both. This means Vanguard has an incentive to suppress competition. Competition is messy. It creates winners and losers. Bankruptcy is bad for a diversified portfolio. This might explain why the American economy has become less dynamic. Why fewer new companies are starting. Vanguard is the sedative of the American economy. It keeps everything calm, but at the cost of vitality. Vanguard knows that this power is becoming a liability. Politicians are asking questions. So, Vanguard has started a pilot program called Vanguard Pass-Through Voting. The idea is simple. Instead of Vanguard voting for you, they give the vote back to you. You can choose a policy. Vote with the board. Vote for ESG. Vote against ESG. Most people are too busy. Most people will just leave the default setting. And guess who controls the default setting? Vanguard. This is the trap. We have built a system where we need Vanguard to aggregate our power to keep fees low. But that same aggregation creates a concentration of power that is dangerous for democracy. In the next part. we are going to look at the private equity threat. Jack Bogle hated private equity. He thought it was high-fee gambling. But the new Vanguard is starting to offer private equity to its wealthy clients. Are they abandoning the Bogle way? If Jack Bogle could see what Vanguard is doing today, he might be turning in his grave. Private equity is the playground of the super rich. It involves buying companies, taking them private, loading them with debt. The fees are astronomical. The standard is 2 and 20. Compare that to Vanguard's standard index fund fee of 0.03%. Bogle called private equity the pinnacle of the croupier's art. Why would a company built on low fees enter the murkiest, most expensive sector of finance? The answer is simple: the race to zero. Vanguard has been so successful at lowering fees that they have almost destroyed their own revenue model. So, the new leadership at Vanguard, led by Tim Buckley, is looking for new ways to make money. They see it as Vanguard slowly morphing into the very thing it was created to destroy. But private equity is just a sideshow compared to the real systemic risk lurking inside Vanguard: the liquidity mismatch. Vanguard is the king of the ETF. ETFs are miraculous. You can buy and sell them instantly, just like a stock. But here's the problem: the ETF is just a wrapper. Inside that wrapper are real assets: stocks, bonds, loans. Some of these assets are very liquid, but some are not. Vanguard manages massive bond funds. Sometimes it takes days or weeks to find a buyer for a junk bond in a bad market. So, we have a mismatch. The wrapper promises instant liquidity. The contents are slow. What happens in a panic? Imagine a scenario where interest rates spike and the bond market crashes. Millions of investors, terrified, log into their Vanguard accounts and hit sell. Vanguard has to pay them cash immediately. To get that cash, Vanguard has to sell the underlying bonds. But nobody wants to buy the bonds. The market is frozen. Vanguard would be forced to sell assets at a fire sale price, driving the market down even further. This creates a doom loop. Regulators are terrified of this. They call it the run on the fund. In the future, a run on Vanguard will happen in milliseconds on a server. This connects to a theory made famous by Michael Burry: the passive investing bubble. He says that index funds have removed price discovery from the market. Price discovery is the mechanism where smart investors analyze a company and decide what it is worth. If a company is bad, the stock goes down. If it is good, the stock goes up. But index funds don't care if a company is good or bad. They just buy. This keeps zombie companies alive. Companies that lose money are kept on life support. Burry warns that this is distorting capitalism. It is allocating capital inefficiently. We have peeled back the layers of the Russian nesting doll. We have seen the saintly origins of Jack Bogle. We have seen the ruthless efficiency of the index fund. Now, we must look at the horizon. Where is the silent giant going? There is a mathematical concept called the singularity. In finance, there is a passive investing singularity. If current trends continue, these two companies could control over 50% of all voting votes. Imagine that world. A world where two CEOs effectively decide the fate of every major company. They decide what cars General Motors builds. They decide what drugs Pfizer develops. It is a world of central planning. It is corporate socialism. In this scenario, competition dies. Innovation slows down. Why invent a better mousetrap if the same guy owns the old mousetrap company and the new mousetrap company? This is the dystopian future that critics fear. But will the government let this happen? History tells us that whenever an entity gets too powerful, the government steps in. They broke up Standard Oil. They broke up AT&T. There are whispers in Washington about limiting the power of index funds. Some propose capping the voting power of any single asset manager at 10%. If this happens, it would be an earthquake for Vanguard. But ironically, it might be good for their business if they don't have to spend money on corporate governance. So, Vanguard is in a delicate dance. They need to be the silent giant. Because if they make too much noise... So, after all this investigation, what is the verdict? Is Vanguard the hero? Yes. Without a doubt, Jack Bogle is a secular saint. He single-handedly saved the American middle class from the sharks of Wall Street. He allowed millions of teachers, nurses, and bus drivers to retire with dignity. But is Vanguard the villain? Potentially, yes. They have created a single point of failure for the global economy. They have concentrated political power in the hands of the unelected. And by turning the market into a passive machine, they may be destroying the very price discovery mechanism. They are the benevolent monster. They feed us. They protect us. But they also own us. The final question is personal. Should you keep your money in Vanguard? The answer is nuanced. If your goal is simply to build wealth, Vanguard is still the best game in town. However, you must be aware of the risks. Risk number one is liquidity. Don't panic sell. Risk number two is voting. Understand that Vanguard is using your shares to vote. Risk number three is diversification. Don't just own paper assets. Own things that Vanguard cannot touch. Own your skills. Own Bitcoin. Own physical gold. Own land. The smartest strategy is to use Vanguard as a tool, not a religion. We are living in the post-Bogle era. The man who hated greed is gone. The giant he built is now run by mortals. Will they stay true to the mission? Only time will tell. But one thing is certain. The days of ignoring the asset managers are over. Rockefeller built the industrial age. Larry Fink built the financial age. Jack Bogle built the passive age. We are just living in their world. But armed with this knowledge, we can navigate it. This has been The Silent Giant. Thank you for watching.